We know that Dogecoin and the crypto market are trading sideways right now, but there are some new data that suggests that we'll get out of this consolidation sooner than you think. So let's talk about it. Let's first look at how Dogecoin is doing right now. It's trading at around 13.5 cents and has pretty much been around the 13 cents mark all week. And this has a lot to do with how Bitcoin is performing since it's the biggest player in the market. So Bitcoin fell below its SMA after briefly surging past the 42.5K resistance trading line earlier this week. But right now, its daily chart reveals that Bitcoin is below the SMA in the descending triangular shape. The 50-day SMA indicator is above the 14-day SMA indicator within the trading shape. The SMA and the bearish trend line are at the 42.5K resistance trading level, indicating the value line as the vital point that will stand against upward forces in subsequent sessions. Basically, there's a lot of pressure, and it looks like we'll see it consolidate for a few more days. Before we talk about the new positive data, let's look at some more bearish analysis. So Brandt said that a resurgence of an already seen event and hence a huge bearish trend may ignite very soon. He said that Bitcoin price may undergo a 30% drop, which may drag the price around $27,000. Brandt believes that the Nasdaq 100 index could mirror the dot-com bubble crash of early 2000 and says that it may be a déjà vu moment. If the predictions of BTC price hold good, then harder days are awaiting for it. We all know that the crypto holds a deep correlation with the stock market, and hence turbulence within the market may deeply impact the crypto space. Now, another analysis came from crypto analyst Capo. He said that Bitcoin could retrace by 50% from current levels. He also said that the prices of altcoins will fall drastically as the total crypto market cap sheds over half of its value. The most interesting part of his analysis was when he said that Bitcoin's recovery from below 39K at the start of the week was a dead cat bounce. He had also warned against getting trapped above $40,000. He was quite pessimistic about Chainlink and Sand too. He said that Chainlink could fall to $5 and Sand could fall to $1. And then another analysis came from trading firm QCP Capital. They believe that Bitcoin has been trading in a larger range as it reclaimed the area around its current levels. The firm said that there are two main reasons behind BTC recent price action. In addition to the U.S. Federal Reserve hinting at an aggressive monetary policy, there are expectations of Bitcoin and Ethereum revisiting critical support at $30,000 and $2,500. These expectations were generated by former BitMEX CEO Arthur Hayes' latest post called The Q Trap. Also, in the options markets, traders are preparing for a potential drop as QCP Capital records a massive selling of May and June calls, causing BTC and ETH risk reversal. These levels dropped from -6% to -10%. And lastly, the demand for BTC and ETH puts has increased significantly. In other words, traders seem to be hedging for the upcoming crash by buying put or sell options. If the price crashes, they will be able to benefit. Now, let's look at another analysis from CryptoQuant. Using on-chain data, it explained why the current Bitcoin bear market looks to be different from the previous ones. Basically, the exchange reserve is continuing to trend down since the price of Bitcoin isn't typical of previous bear markets. If you don't know, the All Exchanges Reserve is an indicator that measures the total amount of Bitcoin stored in the wallets of all centralized exchanges. When the value of this metric trends up, it means the supply on exchanges is increasing. Such a trend may be bearish for the price of the coin as investors usually deposit their crypto to exchanges for selling purposes. On the other hand, the reserve's value going down would suggest holders are withdrawing a net amount of coins right now. This trend, when sustained, can imply accumulation may be going on in the market and thus could prove to be constructive for the price of the coin. Now, here is a chart that shows the trend in the Bitcoin exchange reserve over the history of the crypto. In the above graph, the quant has marked some previous price ATH and the trends in the Bitcoin exchange reserve that followed them. It seems like the value of the indicator rose up during the bear markets starting from 2014 and 2018 after the respective ATH were formed. A bear market seems to have griped the market in the last few months, but unlike those previous bear market examples, the exchange reserve has actually been going down this time. There could be several reasons behind this trend. One major factor may be that part of the supply has just shifted into new investment vehicles such as ETFs. Whatever the reason may be, one thing's clear. This bear market is looking to be quite different from the previous ones, at least in terms of the exchange reserve. Now, let's move on to why I think we'll get out of this bear market sooner than everyone expects. So one of the most common Bitcoin fear, uncertainty, and doubt critiques is that the majority of supply is heavily concentrated in the hands of the few. But now, a new report has revealed that Bitcoin's share of supply held by estimated retail individuals has been taking more share of the network every year. So what Glassnode found in their analysis a year ago was that we can derive that around 2% of network entities control 71.5% of all Bitcoin. Note that this figure is substantially different from the often propagated 2% control 95% of the supply. But now, things have changed. When digging into the entity's supply distribution data today, it found a clear trend of retail increasing their share of circulating supply from 1.51% in 2012 to 13.90% in 2022 on average. And this is great because when the concentration of Bitcoin spreads out so much, in the long run, Bitcoin will hold strong. Another thing we need to remember is the next Bitcoin halving event. So according to Coinmetrics, Bitcoin is reaching its fourth halving event, or the fourth protocol-designed 50% drop in block rewards that occurs about every 4 years. The next halving event is expected to occur around May 4, 2024, when Bitcoin hits 840,000 blocks. Because there are 744 days until this happens, we are halfway between the third and fourth halving occurrences. And this is crucial because in the past, Bitcoin halving events have been followed by gradual and significant price rises over time, culminating within 1.5 years. If the same thing happens with the next one, it's going to bring a lot of money into Bitcoin and then other cryptos. Now, let's talk about another reason why I'm optimistic. So Bloomberg's senior commodity strategist Mike McGlone said that Bitcoin is becoming collateral in the world's paradigm shift, marked by Russia's invasion of Ukraine and China banning cryptocurrencies in 2021. According to McGlone, these two events may mark a paradigm shift illustrating the risk of autocratic, old-guard societies falling behind as the digital world advances. He then also said that in a world going digital, Bitcoin is becoming collateral, and most investors are just starting to move from zero. Now let's look at another analysis. So crypto analyst and trader Jason Pizzino said that Bitcoin could hit a 7-figure price over time. Pizzino said that it's not too far out of the question for Bitcoin to rally by around 25 times and reach a price of $1 million. He also said that a 25x might seem like it's a little far-fetched, but as we can see from December 2018 to the current top in 2021 in November, it's basically been a 22x return. So 2,100% here. So it's not too far out of the question, but I just think it's going to take a lot more time than people are expecting. The analyst also said that for Bitcoin to reach a $1 million price, it has to overcome challenges such as severing its tie to equities. And according to Pizzino, Bitcoin is highly correlated to the Nasdaq stock index. Some of the challenges that we've got to get through is decoupling from the Nasdaq. The problem lies with the Nasdaq itself being that we could be in for more downside in the Nasdaq, which means more downside in Bitcoin and Ethereum, and of course cryptocurrencies. Now, let's look at this for a second. So in the previous article, Mike McGlone pointed to a chart showing that so far in the second quarter of 2022, Bitcoin has remained largely at the same level as in the first quarter of 2021 in terms of volatility, compared to the S&P 500 and the Nasdaq 100. I think it suggests that the correlation might not be as strong as everyone thinks it is. And this is crucial for another reason. This chart suggests that Bitcoin was in a rather bad position at the same time last year. And we all know what followed. This, along with some other data, implies that we can see the same highs we saw last year in October. Now, let's look at another analysis for ETH. In a series of tweets, Justin Bennett talked about Bitcoin and ETH and where he thinks we're heading from here. He said that ETH bear now, bull later. As his chart depicts, Bennett predicts ETH will crash to the $2,500 to $2,700 range before rocketing back to previous all-time highs and beyond. He then backed up his short-term bearish thesis by saying that the bullish fairies didn't save us overnight, so I'm still looking for more downside. ETH seems intent on a 2,700 retest, maybe lower. Looking forward at Bitcoin, he warned that BTC may need a reset in the 37 to 38K range before continuing growth. He then said that Bitcoin's future may ultimately depend on the movements of one non-digital asset, which is the Nasdaq 100 index. He said that, Bitcoin aside, the next move for crypto boils down to the Nasdaq's ability to hold above 13,000. Give that up and the similarity strengthens. But as I said earlier, the correlation might not be as strong as everyone thinks it is. Now let's come back to Dogecoin. As you can see, there's a lot of bearish momentum in the market right now. Doge is currently below most of its moving averages, but because of its overall high correlation with Bitcoin and everything we talked about today, I believe that Doge can get out of this. In any case, let me know what you think in the comments section below.